So today, this is 15-2 work together. We're going to continue on with our adjusting entries. You did those expenses, the office and store along with prepaid insurance last time, showing that if the supplies goes down, we need to account for what was used by putting it into the expense and then updating the asset supplies office. Same thing for supply stores. If it went down like it did, we would show the decrease with the credit, debit expenses, debit the insurance that we used, um, expense that we used, and then take away from the prepaid insurance and by crediting it. So we credit the assets there. Now we're going to be working on two new adjustments. The first one says physical count merchandise inventory. December 31st is 96,471,725. We're supposed to do the adjustment for merchandise inventory. We have two tabs here. Has all your unadjusted entry, has every account, even if they don't have balances, debits and credits. So nothing new, it's kind of a review from last time, checking that out. Here's merchandise inventory. Okay, the unadjusted trial balance. I know it says December 31st, but this is an unfinished document, right? This is the first part of the trial balance. So the beginning balance for merchandise inventory is 94,845. It now has 96,471. So to figure out our adjustment, we take the beginning or unadjusted trial balance where they got it from the general ledger, right? And then they take the end, which we got in our directions. We can see 94 and 96 is an increase. So you have an increase to merchandise inventory of 1,625.94. You just subtracted those two. How do you increase the merchandise inventory? It's a debit balance. So you would debit merchandise inventory for that amount that it increased throughout the year. We want to show that at the end of this fiscal period that our merchandise inventory number is showing accurately at 96,000. So we need to add to the beginning balance the number that we had there. So that'll be your first adjusting entry. Debiting merchandise inventory for that amount and crediting income summary. Merchandise inventory, unlike our ones from yesterday, don't have an expense, so it doesn't go with that. Merchandise inventory can be either. So that's the first one. Second one says single note receivables outstanding December 31st, 90-day 8% note started on November 22nd. Okay, we need to find out how much interest we have receivable coming, even though it's not going to be up to date. We want to match that realization of revenue with this note. So we're not going to take all 90 days. That would be a mistake, even though we get used to saying that. Why aren't we doing it? It was signed on November 22nd. So we are only going from the 22nd to December 31st. So how do we go about doing this? This is our formula for figuring out the accrued interest income. Okay, what we have is principal times rate times fraction of time. Find the note and adjusted trial balance. We have $8,000. Where do we get that again? The note receivable, $8,000. Find the number of days. So there's 30 days in November. So 30 minus 22, because in the instructions it tells us November 22nd we signed it. So we have 8 days in November worth of interest. We have 31 days in December, so we add those two up to have 39 days of interest we need to account for. So we put it back into that same formula. I'm just kind of abbreviating here. Principal times interest rate times days. Again, we know that this is going to be $8,000 note from our unadjusted trial balance note receivable. And then we have 8% interest. We know that from our instructions. And we figured out 39 days over 360, and that comes up to $69.33. And then you would go ahead and for this, just like you did up here, you'd have to have your debit and credit, and you would have interest receivable, and it would be for that $69.33. And then you would have interest income 69.33. Oops. There's going to be rounding. You're going to have to round up. But that'll be your two adjustments. You can use, this kind of help, hopefully, to help you with the application problem as well.